We're in 3 years and counting a severe down cycle at the moment. That's being driven by a deluge of new supply from China, which is creating global overcapacity. And at the same time, we've had a hit to demand. Leverage both INEOS groups is really at quite severe levels. We're at now around 9 times for group holdings and 8 times for Quattro. There is a lot that could go wrong, but at the same time, there are also some clear positive catalysts.
This podcast is for informational purposes only and does not constitute investment, legal, or tax advice.
Welcome to Fixed and Floating, the credit podcast. My name is Josef Pschorn, and in each episode we explore the forces shaping credit markets. Today I'm very pleased to welcome back Tim Riminton from Bloomberg Intelligence. After the strong interest in our last episode on the chemical sector, we decided to do a follow-up. This time taking a deeper look on INEOS and its credit profile. Tim, welcome back.
Joseph, thanks so much for having me back. It's a pleasure to be here. And although, as you all heard last time, I'm a credit analyst, actually, I think at this stage you could say INEOS has become my specialist subject. I've been covering it for 3 or 4 years now. It's a pretty interesting high yield story, lots of complexity, and it also ties in quite nicely, I think, to the broader chemical market themes we were talking about last time. So yeah, hopefully it's an interesting and informative discussion.
No, absolutely. Looking forward to get more insights into this interesting story. I mean, before we dive deeper into INEOS specifically, could you briefly recap the key themes we discussed last time on the chemical sector and also the main structural headwinds the industry is facing today?
Yeah, so let me just give you the 30-second version, given we covered everything last time. So we're in 3 years and counting a severe down cycle at the moment. That's being driven by a deluge of new supply from China, which is creating global overcapacity. And at the same time, we've had a hit to demand. This has been especially the case since 2022, when we had inflation, higher rates, cost of living pressures, partly tied to the war in Ukraine and rising energy prices, and the unwind of the COVID boom, especially in goods spending. So we've got a cyclical downturn in construction hitting 3 of the major construction markets simultaneously. That's the US, Europe, and China. China, obviously, where the property cycle that had been in double digits boom for over a decade finally burst. So this is all contributing to create a really tough environment for chemicals companies across the credit spectrum, across the world. And I think INEOS is a pretty good example, given its global presence and commodity focus. It's been, well, really severely hit by this down cycle.
Given its relatively bad performance, INEOS has been a key focus in the chemical sector for quite a lot of credit investors. But it's also a very complex one. It has 2 issuing entities, INEOS Group and INEOS Quattro. Could you walk us through them?
Yeah, absolutely. So firstly, we've got INEOS Group Holdings. This is what you could call the crown jewels of the whole INEOS empire. They have large assets in olefins, which, remember, that's your key commodity chemical value chain. Ethylene, polyethylene, polypropylene, that's all in the olefins value chain. And it has some pretty significant cost advantaged positions in the US and Europe. And it's held up slightly better than its sister company. The other debt issuing company is Quattro, INEOS Quattro. That was formed relatively recently in 2020 when INEOS bought some acetyls and aromatics assets from BP. We don't need to get into too much detail about those specific value chains, but essentially that led to the combination of 4 quite different businesses from a chemical value chain perspective, and also left that entity with quite a high exposure to Asia. Both boxes are commodity chemical producers, and they've both suffered severe downturns in their earnings, and both have seen new lows in 2025. Again, just as a quick reminder, that was linked to the ongoing down cycle combined with the tariff disruption, which caused a lot of uncertainty and a hit to demand around Q2 rolling into Q3. Looking at the financial profile of both groups, leverage is really at quite severe levels. And, this is even accounting for the fact that you would expect leverage to be higher at these cyclical companies in the down cycle. We're at now around 9 times for group holdings and 8 times for Quattro. That's on a net basis. As I said, really extreme levels, not comfortable and not sustainable unless something changes, hopefully in the form of rising EBITDA or otherwise reducing their debt level over the coming years.
So you mentioned just a kind of divergence between both entities. Is it driven by that new cracker in Antwerp INEOS is building?
Yeah, so that's a big part of it, and another part of this, what makes the story interesting. So, the group holdings entity, that's the crown jewels entity, that is building Europe's first new cracker in more than 2 decades. It's called Project One. It's costing them about 4.8 billion euros, the majority of which is debt funded. And that's pushed debt at that entity up to about $13 billion currently, from just $7 billion in 2021. So, to go over again quickly, a cracker is your bread and butter chemical production facility. You're taking hydrocarbons, in this case, cheap US gas, and you're converting it into a chemical feedstock, ethylene. And the key advantage for this site is the fact that it's arbitraging the US low-cost gas that we discussed last time as a result of the fracking boom in the US. And it is selling it compared to the high-cost base in Europe, where the majority of cracking is on the oil, using an oil derivative, which is just a more expensive and a bit less efficient process. Quattro, meanwhile, its debt has held relatively steady. So we haven't seen a big increase in debt in that entity. But the issue here has been earnings. Earnings have proven a lot more cyclical than they have at group holdings. They've fallen, I think, over 60 or 70% from their highs. And it doesn't really have a clear deleverage catalyst outside of market recovery. It's already been free cash flow negative for a good few years now. It's probably going to remain that way. And unlike with group holdings, it doesn't have this big new project which is meant to sort of come online in the near term. Project One is expected to launch potentially at the end of 26, and there we're expecting and hoping for an earnings boost in 2027. And I think just one more point to sort of underline what I mentioned before about group holdings having this strong position on a cost basis. If we exclude all of the sort of the special costs associated with this peak in capex, so that's the capex spending, the interest costs associated with the debt taken on to fund Project One. If we exclude those from group holdings has actually been a free cash generating asset throughout this down cycle so far. So we can see, sort of from those sort of underlying dynamics that, one has an underlying cash generative business and the other on a sort of a like-for-like basis is cash negative. And that is kind of the root of the divergence there.
Can you explain why Quattro's earnings have been so much weaker than group holdings? Has it something to do with the end markets?
Yeah, so end markets do explain some of it. So Quattro has a much higher exposure to the construction end market, and especially in Europe. And that's kind of it's been just going through a down cycle since the rise in rates and the war in Ukraine. And I guess on the Europe point, it's actually kind of the regional differences between the business, which I think are a big factor. So Quattro, about a third of its revenues come from Asia. And although there's been a lot of focus on, chemical challenges for chemical markets in Europe, and we've been tracking asset closures there, and that's a big theme in the market. Actually, when you look at margins are weakest in Asia, and that's something that not only Quattro has suffered from, but other big chemical producing companies as well. It's sort of tended to be, this is a massive generalization, but across the chemical sector, companies with higher exposure to Asia have seen their earnings under more pressure than their peers who have a greater share in Europe, and especially those with a greater share in the US, which has proven to be much more resilient. By contrast, Group Holdings, that entity has less than 10% of revenue from Asia, and is much more focused on the US and Europe. In fact, at the minute, the US is probably accounting for over 50% of its earnings. And like I said, that market's just remained more resilient. Going back to our discussion last time about the cost advantages of US assets even, linked to the cheaper feedstock, and that kind of, that feedstock at the very beginning of the chain sort of feeds all the way through, and helps keep that whole market more competitive than most of the rest of the world. Another point to make are the product slate of the different businesses. And we spoke about Quattro having 4 different value chains, but ultimately what has been shown through this down cycle is the products that are produced in those value chains are ultimately just more commodity grade. It has less pricing power than Group Holdings seems to have been able to hold on to. And just to give you an example from that, we've got ABS, which is kind of like an advanced polymer of styrene. It's used a lot in automotive productions. So probably the bumper on your car is made out of ABS, plus a lot of internal components as well. It's a very hard-wearing plastic. And up until a few years ago, that was actually kind of a high value-add product with a decent source of margin. But the oversupply, the build-out in China has pushed the ABS market into oversupply, and margins have just collapsed, and Quattro has actually been forced to close one of its North American facilities producing this product, which is quite a surprise given sort of what a boost it was just recently. And then, going back to the final point we've mentioned is the differences in the cost basis. Quattro doesn't really have any sort of specific assets that it can point to and say, this is like its position on the cost curve in this part of the region, means it can generate, solid, reliable, and sort of extra normal margins. Its styrene business, Styrolution, in the US, that is well positioned on the cost curve, and it does seem to be holding up better than some of its peers, but it's still under pressure. It does have what it says is a leading asset in the sort of top handful of assets for this production in the world, in aromatics in Asia. But that division has basically been making, it's gone through about 20 million EBITDA from hundreds of millions a few years ago. So even though it's a top asset, it is in the wrong region and is not able to extract margins. That's how kind of weak the environment is. And if we just draw a contrast to Group Holdings, we can look at Rafnes. This is their cracker in Norway. And the interesting thing about this cracker, in regard to Project One, is this is kind of like the mini Project One, the test case. Since about mid last decade, when they upgraded it, they have been already shipping in US ethane from a bunch of ships they lease, cracking it at this facility in Norway, and then selling it into the European market. And that entity, we estimate has been a sort of a solid 200 to 250 million EBITDA contributor to the European division. And it's been running, according to INEOS, apart from a few sort of scheduled maintenance cycles, pretty much at 100% throughout the down cycle. And basically, I can't really think of any other chemical asset in Europe which can claim the same track record there. So, that's kind of giving you hopefully a bit of an understanding of the differences between the credit profiles of the two groups there.
Beyond the two main operating profiles, how should investors think about INEOS' very complex financing structure, where they have multiple ring-fenced financing boxes rather than one single balance sheet?
Yeah. So there is one single balance sheet if your name happens to be Jim Ratcliffe. So he's the majority owner of INEOS. And he owns about 60% of the business, and the remainder is split between his two co-founders. So, just to confirm, INEOS is a private company; it's not listed. They hold their shares in a holding company, and then sort of through a web of subsidiaries, which is sort of relatively confusing. They own all of the other assets in the wider group, and from their view at the very top, they kind of do have this overall view of the whole group. It's just that us as creditors, as bondholders, we don't see that view. We just see these sort of snapshot into these two chemical assets. There was actually a third restricted group that issued loans, INEOS Enterprises. That's redeemed its last loan just this year, actually, in 2025. So that is no longer reporting results. So we've got a bit less view of the overall group. But to give you kind of an idea of what else is in this, ultimately what we now have to call a conglomerate, it's not even just a straightforward chemical company anymore. We've got oil and gas assets. So INEOS started off buying some oil and gas assets in the North Sea, and it's recently been investing quite heavily in the US. It spent billions over the last couple of years buying onshore shale assets, and then just this year some offshore assets in the Gulf of Mexico / Gulf of America. That entity last year made about 600 million EBITDA, so not insignificant at all. Not as much as the chemical assets, but definitely significant. It has chemical assets outside of the three restricted groups that I've mentioned. One of the main ones is Grangemouth in UK. There's just been some news out about this this week. So the UK government is contributing to INEOS's investment in that facility to extend the life, to keep it running. There was actually some positive reaction in the markets to that. Just to clarify, on Grangemouth, it's not part of the restricted groups of INEOS Group Holdings or INEOS Quattro. But obviously, I think markets just seeing that potentially there is support for chemical assets out there from governments. What else have we got in the box? We've got automotive. So again, this is a relatively new venture. INEOS decided that it wanted to get into the car building game, and it's created INEOS Automotive. Last year, it sold about 8,000 vehicles in the US, which accounts about for 60 or 70% of the group's sales. But just to clarify, we believe that this has been a big cash drain. Last year, 2024, it made minus 30 million EBITDA. Obviously, they're trying to pitch that as a growth story. It's just started out. It's only been shipping cars for 2 years or so. But it has been a consideration for creditors, because there's been some asset leakage out of cash leakage out of the restricted groups, partly to fund the large amount of capex that's needed to get a whole suite of new vehicles on the roads. And then finally, but definitely not least, is INEOS Sports Ventures. So probably everybody listening to this will have heard about Jim Ratcliffe buying a 29% stake in Manchester United football team. That stake is now within the INEOS group. That was moved about a year ago. On top of that, they bought a 1/3 stake in Mercedes F1, which they still own. And they've also got involvement in other ventures, from cycling, sailing, and other sponsorship deals, including rugby. So, It's a big, complex conglomerate. We only see small parts of it, and we kind of have to make do with what we find on Companies House to sort of piece together this larger picture.
Just to make sure, creditors only have a claim on the respective chemicals assets, not on the wider group assets, correct?
Exactly. So we see this quite a lot in private companies when they issue debt. The terms of the bond documents, they will sort of specify which assets are in what we call the restricted group and which assets are outside of it. And that is just basically a legal way of sort of creating a fence around some assets, using that as an asset base to raise debt off of, and just limiting the risk to the wider group. Because if you've raised, well, as they have, about 13 billion plus of debt at the group holdings level, and let's say sort of everything turns out to be a disaster, and all of those assets go to zero. Well, that just means as a creditor, well, tough luck. You can't go and say, well, give me your share of Mercedes F1, or I actually want those oil and gas assets, because those are sort of outside of the terms of the credit agreement. Like I said, that's quite usual in high yield markets, and especially from private issuers.
Coming back from financing structures to operating profiles, you mentioned Project One as one key credit consideration for INEOS. Why is that? Is there uncertainty about the project's viability, and just how much EBITDA contribution is there to be expected?
So Project One is key because with its completion, INEOS are going to end this period of peak capex. So to put that in context, this year, 2025, INEOS Group Holdings will spend about 2.1 billion on capex. That's vastly more than its EBITDA currently, and that capex number should fall to about 700 million. We expect from 2027. So that's immediately freeing up a lot of cash flows. It should mean that they stop adding to the debt on their balance sheet, and in time, sort of hopefully pave the way for that debt pile to start reducing. The second, as you mentioned, is the EBITDA expected from this project. So they've recently increased their guidance to about 700 million per year from Project One. And they've clarified that 700 million should even be the case in the first half of 2025, that sort of environment. That was increased from a previous guidance of around 600 million. So I'd say the market is somewhat skeptical. They just happened to come out with an increased guidance in their worst year in the down cycle so far, just before they priced the new bond. Maybe that's a bit suspicious. So we obviously decided that we'd sort of run the numbers and take our sort of best guess at what we think the EBITDA might be. And actually, we don't think the 700 is so crazy. The reason for that is the feedstock arbitrage that I was mentioning earlier. They're buying this cheap US ethane, where in the US there's this surplus of ethane due to all the fracking boom there. They're shipping it to Europe, where the majority of European assets are producing ethylene from oil, which is a more expensive feedstock and a less efficient process. So that means in Europe you're selling ethylene, for sort of up here, around $1,200 a ton, but you're producing it at US economics. And to sort of give you an idea of what the differences might be, Europe ethylene price 1,200. In the US it's more around 800. So really quite a big difference there, and that kind of guarantees the margin for that asset, and it also means that it's going to be kind of the best thing since sliced bread in terms of chemicals cracking in Europe. It's going to be bigger and more modern than Rafnes. Rafnes was originally built in the late 70s. you can imagine how much technology's come along since then. So Raffines has been running at 100% through this down cycle. We expect Project One to be running at 100%. As long as there are no sort of operational issues. The other key point about all of this sort of arbitrage of feedstock, it means that those earnings are quite market agnostic. We're not relying on a broad market pickup here. INEOS Group Holdings Project One should be generating EBITDA even in the weak environment that we have now. If we obviously do get a recovery, that's positive for the whole sector, and Group Holdings can benefit from that. But crucially, it has this positive catalyst that doesn't depend on that. What does that look like in terms of leverage? Well, we think leverage will go down to around 6 times in 2027. That is up from what we saw about a year ago. And that's kind of a reflection of how bad 25 has been. And, that's meant that they've had to raise more debt than we previously expected. But, the point is that they'll be, for once, or not for once, for the first time in a while, moving in the right direction. We think leverage could peak up to about 10 times in 2026. And the final point is this point about free cash flow generation, which is always crucial when we're looking at credits. We think that boost from Project One will get them back to cash generation, and that will help them sort of, over time, probably over quite a long period of time, renormalize that balance sheet and, get back to what we'd consider a sort of a more normal leverage level, which they aim for a leverage level around 3 times. So you can sort of tell how far away we are from that now, and a 3 times leverage would sort of leave them in a much more comfortable position on basically every other metric you can imagine. It would sort of imply lower interest costs that would free up free cash flow further. That's kind of the story there, and it's all being driven by this project.
Is there also a risk that bondholders don't benefit from that new asset? In the past, the group has paid relatively large dividends and also has granted related party loans.
Yes, it's a very good point. INEOS does have a history of moving cash around, and sometimes the issue is the cash moves out of the restricted group. And I should clarify, for creditors, that's kind of the main thing that matters. Once the cash has gone out of Group Holdings or Quattro, it hasn't tended to come back in, and they've done this via dividends. So the dividend from the restricted group goes up to one of the other subsidiaries, and then we kind of lose sight of it a bit there, and also through related party loans. So they used a related party loan to help finance one of the recent oil and gas acquisitions. That was for around $700 or $800 million. So not insignificant sums. And back in sort of 21, 22, even early 23, those two entities have paid out multiple billions in dividends. The interesting thing is, though, not from what we can tell from sort of the wider subsidiary statements we get on Companies House, quite a lot of that cash is not going up to shareholders. It's actually just sort of being redistributed around all of these different assets we talked about. The automotive division, that's required a huge amount of capex to sort of get it off the ground. So the point there is that it is a risk. They do kind of have a track record of doing this. I think the key difference here is that this down cycle is very severe. It's much worse than was expected when they were making all of these dividend payments, back in sort of 22, 23. And since then, they basically stopped dividend payments out of the two credit groups. And I think, that management has been talking up, their aim to get leverage down. And that they kind of need to do that. They're being forced to do that. On the credit rating side, they've seen a lot of pressure on their credit ratings. Moody's just downgraded them the other week. And also in the markets, market pricing is now, if they issue new debt now, it's very expensive. And really, they need to try and get the market back on side. And the way to do that is to improve your credit metrics. It's not to be paying out the proceeds from the generation on Project One's side.
On the maturity wall, how bad is it really? I mean, the documentation appears relatively weak, consistent with typical high-yield documentation standards. And it does also permit substantial additional senior and also pari passu debt capacity, potentially in the range between 1 and 8 billion, what I've read. What needs to happen for the two groups to be able to refinance in the coming years?
Yeah, I mean, I think the key word in your question there is refinance. Although they might have capacity in the docs, I think, frankly, the appetite in the market for, net new issuance, i.e. New debt, not refinance debt, for these issuers right now is very limited. Quattro's bonds are trading with a yield around 15% at the moment. They obviously don't want to pay that if they can avoid it. And, that's telling you the market thinks this is a very, very, very risky lender at the minute. So the key thing that they need to do, in my mind, is get the refinancing question answered. INEOS Group Holdings has about $2 billion of debt coming mature in 2028. And that starts a series of years where they've got quite high maturities in 29 and then stepping up even further in 2030 and 2031. They will need to come to the market at least a year ahead of those maturities. And that's kind of high yield market standard. These issuers need to be proactive. Part of the reason for that is high yield markets have a nasty habit of closing sometimes when you need them most. That's often caused by market volatility or a risk-off sentiment. But in those sort of market sell-offs, you essentially can't come to the market and price a new high-yield bond. There's just not the appetite. So you need to come early to mitigate that risk. And the other reason is the credit rating agencies. They tend to start downgrading high-yield companies, especially the single B or low double B ones, if they're not very proactive on the refinancing. And that just comes down to the fact that most high yield issuers, by virtue of being high yield, aren't normally in the position to just repay maturities with cash if they really need to. They rely on refinancing to sort of keep the show on the road. In Quattro, they've got 1 billion in maturities in 2027. So that's causing some concern in the market right now. As I just said, 15% coupons, it doesn't look like they have market access to refinance that whole 1 billion in the markets. It's going to be extremely expensive for them if they do that. Given they're already free cash flow negative, that doesn't seem like a great option. What they've been talking about is using inventory financing. I think overall this can work potentially with a bit of using a bit of cash on balance sheet as well. The key thing for them now is just to get that done. They've probably left it a bit late, and that's causing sort of extra concern in the complex at the minute in the markets. After that, though, Quattro has 4 billion due in 2029, and this is kind of like what I think will be the make or break timeline for Quattro. So, given what we just said about high yield issuers needing to be a bit proactive, that probably gives Quattro until 2028 for results to improve. So it's once it's got the 27s out the way, it's kicked the can down the road. It has a bit of breathing room. It has the cash on balance sheet, but it needs to use that time to improve its credit profile. The easiest method for that is for earnings to go up, and this is kind of where it doesn't have this nice positive catalyst that Group Holdings has. And it's just hoping that the market recovers. And maybe it does, maybe it doesn't. I think you're probably gathering that we're a bit more constructive on group holdings than Quattro in our fundamental assessment. So what's the alternative if they don't improve earnings? Well, that's kind of that's kind of the question that markets are asking at the minute.
I mean, that sounds pretty challenging, especially for Quattro. What needs to happen so that the situation improves materially?
So the number one thing for INEOS overall is to get Project One launched and to have that generating the sort of EBITDA that they're advertising. Maybe if it's a bit less, it would still be all right, but kind of get them back to free cash flow generative. Then you can kind of say that box looks okay. We don't need to worry so much about that one. On the Quattro side, as I said, their EBITDA having a 700 million boost would be absolutely wonderful, and that would kind of get them back into, we don't need to worry about this box anymore either. It just there isn't the positive catalyst, the clear view of that materializing. We expect them to have a bit of runway until 2028, but they're just kind of relying on markets improving. Maybe there are some early signs of some areas of their business improving. We'll have to wait and see in 2026. If they don't do that, Quattro is kind of left with a few choices. It can sort of turn to the wider group and say, this time, we need help from you. We've helped you in the past. Ultimately, that will be a decision of the shareholders. Like I said, they have this overall group view, so they would need to decide that they wanted to take cash from another part of the business and put it into Quattro. Not impossible. The other thing which bond prices are essentially reflecting now is that there's a risk that they have to enter negotiations with creditors, which could lead to one of a variety of default scenarios.
If markets would improve, what would that have an impact in terms of EBITDA generation?
I mean, that really depends on the extent of the market improvement. I think for us, these companies give guidance on what they see as top, mid, and bottom of cycle. For both entities, what they actually generated this year is well below what they see as a normal bottom of cycle level. And we think, given the challenges, the structural challenges in the market, that mid cycle, that sort of normal average earnings level is probably quite a bit lower than the guidance that we've heard from the company in the past. I think looking at it in just terms of like what is a minimum level for these two entities that we'd want to see. For group holdings, it's roughly around $2 billion of EBITDA. Euros, 2 billion euros of EBITDA. That gets them to cash neutral once Project One is completed. At the moment, in 2027, we're estimating around 2.3 billion. So, like I said, it's kind of okay. It's above that sort of minimum threshold. For Quattro, it needs to get to about 1 billion euros to be free cash flow neutral. But on our outlook at the minute, we only see around 800 or so in 2027. That could change. Modeling these companies multiple years in the future is kind of a finger in the air exercise, given the current market disruptions and uncertainties around demand. But it does seem that it's quite far away from that sort of 1 billion mark at the minute.
I mean, you can look at assets in terms of cash generation, but also value an asset on replacement cost, i.e. for a strategic player. But are there enough value left if the company is going free cash flow negative for the next 4 or so years?
Yeah, so we've just looked at this. This is becoming a a really pertinent question in the market for Quattro. I'll put group holdings aside for now. I think it's clear that the value in that Quattro box is a lot less than the company thought it was when they formed it in 2020 and issued the inaugural Quattro bonds in 2021. And that's just been a really, this really rapid and significant structural changes in the market, which kind of nobody in the industry really thought would be as bad as they have turned out to be. That said, we have had a look at it. We've looked at the assets, and we think that it's not all sort of terrible. It's not like we think that Quattro can sort of or would sort of cease to exist. There's enough of an asset base there in two of the boxes anyway. It has valuable assets that are well positioned on the cost curve or have other advantages that there would be potential buyers out there if it came to that. So the best asset in that box is the Innovin division. So Innovin produces PVC. I think the clearest way to think about PVC is about 60 or 70% of it goes into construction. So demand for PVC very closely linked to construction. And right now we have a cyclical downturn in Europe. Innovin is a totally European-focused business, and that cyclical downturn in construction is kind of normal. Right? We've had a spike in inflation and a spike in rates. A dip in construction would be a natural response to that. And now, rates have come down, inflation has come down. We also have potential German fiscal spending coming down the pipeline as well. It could be that we come out of this cyclical downturn in construction, and we just sort of hopefully, go back on as, in a sort of more normal trend. I guess the point I'm trying to make there is that the downturn in demand for PVC is not structural. It is sort of a normal cycle. The other thing to know about Innovin is it's a very energy intensive process to produce PVC. So the C in PVC relates to chlorine, and we produce chlorine by taking salt. So we mine salt generally from under the ground, and we then make a brine, i.e. mix it with water, and then you put it into an electrolysis plant. You may remember this from like GCSE chemistry. If when you put an electric current through water, bubbles of hydrogen sort of come out of the water. You're splitting the water into its two component elements. When you do that with brine, you get oxygen. You don't actually get pure oxygen. Sorry, my mistake. You get chlorine gas, and then you get caustic soda, which is a combination of the oxygen and the sodium. Yeah, got there eventually. But crucially, as you can tell from that method, you've got to pass a lot of energy through brine to get enough chlorine to produce a significant amount of PVC. So it's been quite hit by the high energy prices we've seen in Europe. And here we've got some kind of rays of hope. Gas prices have already been trending down this year, and in 2026 we're expecting to see a record ever increase in global LNG, that's liquefied natural gas capacity, coming online. The crucial thing about liquefied natural gas is it's transported on ships, so you can produce gas in Qatar and the US and basically sell it anywhere in the world. Before liquefied natural gas, all gas was basically transported by pipeline. That meant that your natural gas distribution was quite regionally focused. Since essentially almost all Russian piped gas is no longer going into Europe, Europe is now very reliant on LNG. So a big increase in LNG capacity is probably, hopefully, going to push down LNG prices, which could feed through into lower energy costs in Europe. Again, this will help reduce the costs for for Innovin and its peers in Europe. And also, again, what we were talking about last time with chemicals being a margin business, it might not actually help the margin, but what it's going to do is it's going to reduce that headline price. If that comes down sort of 10, 15, 20%, that's going to be really helpful in making Europe a less attractive import market for exporting countries. And that will hopefully help reduce the pressures that the PVC market's currently seeing from imports elsewhere. Finally, we've got potential catalysts like peace in Ukraine. It's quite uncertain, but could offer some support via demand and potentially support lower energy prices as well. And I guess the final point to make about PVC is this value chain is, interestingly, it's not involved in this huge build out we're seeing across the world, mainly in China. So its global utilization rate isn't expected to fall into the 70s. In fact, the lowest it's expected to go, and we're working on Nexent figures here, is around the low 80s, and toward the end of the decade, that's going to sort of grow up to the high 80s on a global basis. What that tells you is kind of like, well, that's kind of a healthy supply-demand balance for producers. They get a bit of pricing power sort of around that level of utilization. So Innovin, that's kind of the main asset in Quattro. Cyclical downturn at the minute, but we do see some potential for improvement coming. I should caveat that we're not modeling on a big improvement. I think it pays to be cautious in high yield investing, but there are some potential positive catalysts down the road, and we think if you're looking on a medium term basis, this asset has value. It can't afford to sort of not exist.
Tim, just you mentioning chemistry classes before gives me shivers. But back to more optimistic thoughts, policy actions such as anti-dumping measures or energy support. What would be most meaningful for INEOS, and what could that realistically mean for EBITDA generation?
Yeah, policy for support is something that is becoming more of a focus, and I think that's ultimately just due to how long the down cycle has gone on for, and sort of how bad it is. So far in Europe, we've seen some anti-dumping measures, but these measures are they kind of have a limited impact because they target one specific product often, or a few related products, and the measures are sort of against specific producers of that product. So they did some on PVC, and they targeted specific companies in the US and Egypt, which they found had been dumping into Europe. When those measures come in, it does have some effect, but it's not solving the overall issue, because though that PVC produced in the US can then be sold into Mexico, and then Mexico can sell it into Europe, or the Mexican the Mexicans that need the PVC to build buildings in Mexico buy it from the US, and the producers in Mexico just sell their product into Europe. Either way, you kind of just get this displacement effect. So they've had some impact, but kind of been limited. And INEOS has been calling for a while now for much broader measures. It has launched a whole series of further anti-dumping cases with the EU on a whole range of chemical products, but it's also, in addition, sort of calling on European policymakers to take more concerted effort to protect the chemical industry, to protect European industry in general. The chemicals industry in Europe employs about 1.2 million people directly, so it's a very big employer, and crucially, it's a vital part of the overall manufacturing sector, which is about 30 million people. So there's definitely a case to be made for some action to be taken. I think it's just difficult to have a strong view on what action that might be, whether it will be sufficient, and whether it will be taken in time, and whether it will be taken at all. So, I kind of put this stuff in the box of, well, this is a nice potential positive catalyst, but it's not something that I'm basing my credit analysis on, on the basis that the EU is suddenly going to take a lot of protectionist measures on chemicals, because kind of history tells us that it might not do that. This time could be different, but it also might not be.
To close this conversation, what do you think the market is currently over or underestimating when it comes to INEOS as a credit?
It's a good question. I think, look, we've spoken a lot about the negatives affecting INEOS in this conversation. It's extremely high leverage. It's extremely high cost of accessing the markets right now. It's maturity walls. There is a lot that could go wrong. But I think, at the same time, there are also some clear positive catalysts. We talked about Project One. We talked about potential for energy prices to come down, for European construction to pick up, for demand to improve. And potentially more speculative boosts like Ukraine reconstruction or direct policy support from Europe. So it's not kind of all doom and gloom. Like I said, we're more comfortable with the profile of group holdings because it has that clear positive catalyst of Project One. There is some execution risk there, of course, but that looks like we can be relatively confident that's going to come down the line. And then within INEOS, it does have some capital allocation options itself. It has valuable assets that it could use to monetize or raise debt, and they do have somewhat of a track record of moving cash around the group. I mean, ultimately that will be up to the equity holders whether they want to move more cash into to boxes where creditors might be able to get hold of those assets if things go badly. But at least it's an option. It's better than not having an option altogether. I guess what I close with is I think hopefully I've given you an idea of what an interesting credit story it is, and I think it's going to remain a very interesting credit story for frankly years to come. So if you're invested in the market, if you're invested in the bonds, stay tuned, and please feel free to reach out to me, and I'm more than happy to discuss more.
Thank you, Tim, for another terrific interview. Where can listeners find more of your work?
Yeah, so on the terminal, that is the Bloomberg terminal, you can find me. You can just type in my name. You'll find me in the search box there. On my profile, on my bio page, you can find all of my latest research, and you can find my email address and IB, and you can contact me directly.
Thank you, Tim, for coming on the show. And also thank you, everybody, for listening to Fixed and Floating, the Credit Podcast. If you enjoyed this episode, please follow and subscribe wherever you get your podcasts, and see you next time.